What's up guys, Jake here. I think I'm gonna make it. In this video, let's do an update to my dead hand options trading challenge, and the reason why today is significant is because Federal Reserve Chairman Jerome Powell spoke and he said that interest rates are gonna be held steady. We were expecting this, but the tapering of bond purchases will not happen until later, coming soon. And coming soon does not mean this month. It probably doesn't mean next month. People are expecting this to start in November or December, so potentially we'll get that announcement next month from the Fed chair in October. So I think the market is going to respond very positively to this. We're going to keep that easy money flowing as the Fed continues basically printing money out of nothing to buy US Treasuries. This is what has been pumping up the market the last 18 months, and for anybody who wants to squeeze a little bit more juice, they got to stay in the market for another month in order to keep catching those gains. So what we've been experiencing the last 18 months is a direct result of Fed policy. Yes, the economy is growing. Yes, earnings reports from companies have been very good. But these dips, if you notice them, these freakouts happen about once a month, and they kind of revolve around the Fed meeting because everybody wants to know, when is tapering going to start? If you're completely confused about what tapering is, I'll include the video down below where I talked about it. And this dip that we've been struggling through the last 2 weeks, I mean, this has been bad, guys. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 red days out of 13. So this has been going on over 2 weeks. There's a snapback happening right now because the Fed spoke. Hopefully tomorrow it's green as well. If we go back a year, we can see when the last time the Fed has been, or the market's been this tumultuous. You know, I don't know how big of a drop this is, but the S&P dropped from 357 down to let's see here, 322 before it snapped back. There then was this kind of double dip before 1, 2, 3, 4 strong green days of buying. So now that I see the pattern here, it's so obvious. I'm definitely going to be playing this next month by selling credit spreads on SPY basically 2 weeks before the next Fed meeting, because this exact same thing is going to occur next month with everybody selling off in anticipation for the market having a negative reaction when the Fed inevitably does announce tapering is going to occur. In the event you're not familiar with my dead hand options trading challenge, check out this playlist on my channel. It will explain, in the first episode, it'll explain basically what I'm doing. A quick recap is I am doubling the amount of just out of the money call contracts every time the market goes down by a certain percentage. So I'm increasingly leveraging more money through options, call contracts 2 months out, in order to basically never lose money. It's a stupid idea. I'll just be honest with you guys. If I can get out of this month, I'm gonna put this challenge on pause. For anybody who's been following this and enjoying this, there definitely were some flaws now that I've experienced level 4 basically. We'll go through it, but let me just show you the snapshot of my account. This was as high as 94,000 2 weeks ago when the market peaked. So I'm down basically 10 grand from my high. I had to sell all my stock to basically free up collateral to keep buying more calls. Obviously, I don't have any covered calls sold. This is my 4 levels. This was 1, which is 2 call contracts. Level 2 is 4, level 3 is 8, level 4 is 16. And I'm committed still. In the event the market does go red tomorrow, I don't think it will. But if it does, and my contracts are down by the total amounts, then yeah, I will try and get it back by going to 32, because I don't see the market starting its decline anytime soon. So for fun, to put this in perspective, how much am I leveraging right now with the 32 call contracts that I've purchased, multiply it by 100 shares of SPY, multiplied by the current share price value, 439, I'm leveraging $1.4 million worth of SPY shares to do this crazy scheme. So I never recommended this challenge or for you guys to copy what I'm doing. I'm the guinea pig. I was willing to put a lot of money on the line. Just to put it in perspective, on July 15th, I started this with 87,000. I'm basically at 85. So I'm only down 2 grand overall, and if the snapback can just continue in the morning, I will close everything to basically get back to net neutral. So I'm up $5,500 today, which is pretty good, but I'm still net down 5,362. So these 16 basically have to make up for the 16 that are still red and probably will stay red in the morning. I need these 16 to really work for me to cancel out the losses here. And the second my total gain loss is positive even $1, guys, I'll basically be back, I'll add 5 to 86. I'll basically be over 90,000. Now you're saying, well, your high was 94. How can you exit at neutral at 90,000? It's because I sold all my shares. The 200 shares of SPY that I was holding at one point was up 3 grand. As soon as that went negative below my cost basis, I just unloaded them because I didn't know if the market was going to keep going down, and I wanted to focus on buying my level 5 and 6 should I needed it. Now you might be asking, Jake, why aren't you positive? There was a snapback today. Isn't this your whole game plan? Yes and no. I mean, it's complicated. So when the market dipped here on the 20th, which was Monday, everybody was panicking about that Evergrande Chinese real estate scandal. Guys, I didn't even bother making a video about it because that wasn't really a thing. Yeah, $300 billion worth of debt potentially being defaulted on. It's a big deal for China, but I think as far as the global markets overall, I don't think it's enough for it to affect American companies. If you're holding Chinese stocks, I mean, they're going to continue dropping, which is a good thing if you're looking to someday in the future. If you're holding Chinese stocks, probably shouldn't be doing that, but as soon as they've bottomed out, like Alibaba, let's jump in. I'll make a video when that happens. But I doubled up right here, and then the market kept going down, like all day. So I think I broke my own rule, and I jumped in at around 10 o'clock. I probably should have waited to see if it kept going down, which it did. If I had doubled up here, then yeah, I think the snapback would have been enough for me to get out of. But because I entered here at basically 436 is where the strike price for my level 4. Being that it's only at 439, it's not enough for me to get out of. I need this basically to get back up here to about 442 a share, and then I think I can get out break even. So what is the major flaw of this whole dead hand options trading strategy now that I've experienced level 4? And it's these drops. Oh my gosh, 10% to double up, 20, 20, 20, 20. Being honest with you guys, I made this number up. I had no justification for saying 20%. With the expiration date being a certain amount in the future, that determines how much of a percentage it drops. The longer the expiration, the lower the drop when the share price moves. The closer you are to expiration, the more that the contracts either gain or lose in value. And why did I say 20%? It just sounded good, but that's not a good strategy. So let's just break it down and think about how I got to level 4 and how this was potentially a disaster for me. So my level 1, I bought just out of the money at 454. This is when SPY was 453.19. I then doubled up when SPY was at 448. I bought my level 2 4 contracts with a strike of 450. I then doubled up again when SPY went to 445, and I bought 8 contracts at 446. There was a small snapback, but it wasn't enough for me to get back to break even. I then waited until here when SPY was lower to buy my level 4, the let's see here, 2, 4, 8, 16 at a strike of 436. The problem is that was only a 4.23% drop. I made it all the way to level 4, 5 and 6, and I'm basically out of levels. I can't double up anymore. And there was only a 4.23% drop in the market. I'm basically doubling up every time the market goes down by 1% from its high. That is not good enough, guys. I'm never going to survive a 10% drop or a 20% drop or a 30% drop. So what should the values be before doubling up? 10 and 20, this isn't going to cut it. It's got to be higher, much higher. So maybe go back to 20% for level 1. This is the least risky. We'll go ahead and say 30% for level 2 doubling up, and then 40, and then 50-50. Once I'm at level 4, I don't want to go to level 5 unless I've lost 50% of the value of these 16 contracts. I then double up to go to 30, 32, and hopefully I can get a snapback where I can recover. Otherwise, yeah, another 50% before I go to 64. I think these percentages are much more realistic of trying to survive a 10, 20, or 30% drop from the peak. But even then, there's so much movement on SPY after hours, and I only get in and out of options contracts during the day. You can only trade options during normal market hours. So there's this element of luck, I feel like, between where the market drops pre-market or after-market, and if you just happen to buy your contracts right before a snap, I don't know. There's no science here, guys. That's what I want to get at. And what I've been doing the last 2 months was incredibly risky. If the market is green tomorrow and I can exit everything for a profit, I am putting this challenge on hold. Mostly because with my job in the Air Force, I can't be at my computer sometimes. Like the entire day the market is open, and when you're on levels 4, 5, and 6, you really want to be at a computer, potentially getting in or getting out of a position. So I just have to suspend this, put this on hold. I think there's going to be another drop similar to this in October, the 2 weeks prior to the next Fed meeting. There's probably going to be a drop in November, and then another drop in December when they actually do start tapering. The market is not going to be happy about their easy money disappearing. But the Fed has to do it to control inflation. We've created this new normal for stock valuations that just isn't justified by normal market forces. As soon as the Fed removes itself, there's going to be a correction. Is there going to be a crazy crash? I don't think so, guys. I don't think that we're going to be negative for the year. When you look at the S&P 500, how much it's up from January 1st, we're up like 19%. The long-term average, what people can't be mad about, is if they get that 10% a year. So go ahead and look at where we are from the high. If we went down to being 10% up, from January 1st to December 31st, I still think this is going to be a positive, net positive year for the market. Don't see a crazy correction, sustaining itself or the economy's in trouble. But yeah, it's going to get really rocky the next couple months. And I probably will make a video talking about credit spreads. I'm going to sell, let's see here, a call side credit spread on SPY just 2 weeks before the next Fed meeting to see if I can capitalize on the market having another panic attack, basically. So just to recap, I'm basically at 85,000, and I'm hoping that I can get another green day tomorrow to wipe out this negative amount of 5,300. Adding that would put me over 90 grand. I started with 87. I'm willing to just call it quits and break even and hold cash for the next couple weeks. I just have to focus on other things, guys, and last 2 weeks have been a little stressful thanks to all of this volatility, but I feel like I learned a lot, and hopefully you guys got something from this. I'm going to be in the field for the next week, so I can't make timely videos about the market, but once I'm back from the field, I'll do one final update to this challenge and give some more of my thoughts. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.